Hello everyone. So we are now starting on with the discussion of the FRM part 1 foundation. Now over here if you'll see the first two topics of the foundation. First two topics, that is you should write down the name of the topics. Number 1 is the building blocks of risk management. Okay, it's in your book 1. Book 1. Two topics, okay, which is there in the foundation. Number 1 is the building blocks of the risk management. Building blocks of risk management. And the second topic is how do firms manage financial risk. These are the first two topics as per the Garb Institute in the book 1, that is in the foundation. So over here I want to tell you a basic thing. If you are studying FRM, okay, if you want to start preparing for your FRM, what you are doing? Financial risk management, clear? So means your whole agenda is to do risk management of the finance, clear? Whether a mutual fund, whether a company, whether a bank, whether a NBFC, it can be anyone. Okay, what was your focus? My focus is to do the risk management, clear? Now these first two topics, building blocks of risk management and how do firms manage financial risk, they are just telling you the whole summary of the FRM syllabus, both part 1 as well as part 2. They are introducing the concepts of both part 1 as well as part 2. Now when you will start from these two topics, you will find out that many things are not discussed in detail. So you need to understand, they don't want you to understand in depth each and every term in the first two topics. They just want you to introduce, they just want you to know that what you are going to study in FRM. Means if I want to reach a destination, okay, suppose from Delhi I want to reach to Mumbai, I need to know that how I will reach, what are the different ways, what are the different stations that will come on the way, how much time it will take. So these two topics are setting up the theme for the entire FRM, clear? So over here, once you will read it thoroughly, and I tell you, you should read it in the beginning so that you will understand the whole agenda. But yes, there are many things you will not understand from the topic, but yes, the basic thematic knowledge will be there with you, clear? See the word building blocks of risk management, that is what I want to know, that what we are going to study in the FRM, it's there in the first topic. Second, if you will become an financial risk manager, how you are going to manage that risk, how? So there are different steps introduced, and in the coming chapters, in the coming books, each and every step will be discussed in detail. So if suppose I am starting my journey from the home to Mumbai, I need to know what are the different steps before I step out of my home. So these two topics are very important, but yes, over here you will understand only 50 to 40% of the topics. 50 to 40% of the topic you will not understand the whole topic, like hedging is there, futures is there, derivatives is there, bonds discussion is there, market risk, operational risk, so many things are there. So if you aim that you will understand each and every terms over here, then what is the use of the other topics, what is the use of the other books? Because these are the summary of the whole curriculum, clear? So if you will see from the author's perspective how they have initiated the discussion of the topic, first they want you to understand that what is risk management. What is risk management? It means what you are going to study. Okay, the introduction of the risk management is there. Okay, then they want you to understand what is the process of risk management. See, they don't want you to do it now. That's the major difference over here. They just want you to understand the roadmap ahead. Okay, now see, when it comes to the risk management, how the process goes on. First of all, suppose you enter into a trade with your friend. Suppose you gave your money to your friend. Okay, it's Mr. A and Mr. B. You have given your money to your friend. Now, is there any risk? First of all, you will ask yourself, is there any risk? This is going to be your first question. Is there any risk? You will say yes. Then I'll ask me, what risk? What type of risk it is? So I'll say there is a credit risk because I have given the money to Mr. B. I have given the money on credit. I have given a loan to Mr. B. That is a credit. So I'll say, sir, this is a credit risk. Okay. Once I know that it's a credit risk, now I want to know how much will be the risk. How much will be the risk? Means now I want to quantify. Now I want to quantify that. Please tell me how much will be the risk, how much amount. Means if suppose I have given $10,000 to Mr. B, now I want to know how much I can lose, what is the probability of losing that money. So I want to know what is my expected loss, what is my unexpected loss. Means something which I can expect, that I can lose this much. Unexpected means I don't know how much I will lose, that is unexpected, means beyond your expectation. Okay, now suppose you will be able to quantify with the help of multiple models which are there, and suppose you get to know that you can lose $300 and the probability to lose $300 is 10%. There is a 10% chance that you can lose $300. Now you will ask yourself whether I can afford this risk or not, whether I can afford this loss or not. Now I will say there are two options, whether I can afford, yes or no. If I'll say that yes I can afford it, if I can afford it, then I should give the loan to Mr. B. I should give the loan to Mr. B, and further I don't need to take any steps. But if I feel that I cannot take the risk, there are two ways. Either I should not give the loan to Mr. B, but suppose I want to take the risk, I'll give the loan to Mr. B, but I'll take some steps, and hedge my position. I want to protect myself. So there are many instruments which can help you to protect your money. Means even if Mr. B will default, you will get the money from the insurance. Just take it an example that you purchase a stock, and there is a fire occurred in the factory. Now in that situation, who will give you the money? Insurance company will give you the money. Similarly you will take the insurance. So this point number 4 is the steps of risk management. See, things are very simple, things are very easy if you'll take it in a proper way, if you'll study it properly, if you'll study with proper examples. Okay, don't take it as a topics you have to cover up. No, gain the skills, gain the expertise, gain the knowledge. Okay, now this part, what type of the risk, what is the type of the risk? We call this as the identification of the risk. Point number 3, how much is the risk? I call this as quantification of the risk. So the topic is divided into 3 parts: identification of the risk, then quantify it, and then if you want to take the steps to manage the risk, yes or no. If yes, then how. See, all these things we are going to study. Identification of the risk. Okay, how many types of risk are there? Clear. We will study how to quantify the risk with the help of different models. Clear. And how to manage the risk, you will study. There are different instruments, different techniques to protect yourself from the risk. Clear. Study it strategically, study it with a flow, okay, which connect the dots. Each and every dots need to be connected. You need to, means once you will reach, suppose there are you have completed 5 topics, 1 2 3 4 5. Now you need to be able to connect the dots, that how my topic 5 is related to the concept taught in the class 1, concept in the class 2, how in further how this will be related to the coming topics ahead. See, everything is a sequence, it's a process. Okay, over here it's not a syllabus, rather take it as a process. Clear. So we are continuing with our part. Number 1 is the risk management introduction by the author. Second is the process. Okay, point number 3 which is discussed by the author is measuring and managing risk. Measuring and managing risk. Clear. Measuring means quantification, managing means what steps you are taking to actually manage your risk, or rather I will use the word to reduce risk. See, if you are using the word eliminate, you cannot eliminate the risk. Okay, 100% elimination is very difficult. To achieve that 100% elimination of the risk is very difficult. If you want to do that, then what is the need of taking the risk? Why we take the risk? To earn higher return. And if you lose and if you remove all the risk, what you will earn? RF, risk free rate of return. Return without risk, return without risk. Clear? And if you are taking the risk, you are earning return with risk. Higher the risk, higher the return. Higher the risk, higher the return. Clear? So in this area, author is discussing there are quantitative risk management techniques, there are qualitative. Quantitative means where maths is involved. Qualitative means where expertise, knowledge, where experience, okay, discussion with the teammates, these all are qualitative. Stress testing, scenario analysis, all these are involved. Then you can have a solution. Enterprise risk management. Enterprise risk management means, if I'll say HDFC Bank, okay, they have multiple business, okay, they are into retail banking, they are into corporates, okay, they are into insurance, they are into investment banking, so many operations they are handling. What is the overall risk of the HDFC as a whole? What is the overall risk of the HDFC as a whole? Sometimes it happens that over here you are taking a buy call in the Reliance, okay, and over here you are taking a sell call in the Reliance. So means what? You are neutral, your risk is neutral. So accordingly take the steps, accordingly take the steps. Because if you will not do this, then suppose they have taken the buy call, now they are afraid that what if the share price of the Reliance will fall. But over here in this department, you have sold the shares of Reliance, you are afraid that Reliance share price will go up, so you will take hedging position in both the situation. Clear? But if you know at the enterprise level that I have taken buy call as well as sell call, then at the end there is no risk for the institution. At the end there is no risk for the institution. Whatever is the profit in this segment will be the loss in this segment, so it will become neutral at the end. Clear? Then point number 4, author is taking you towards the types of the risk. Types of risk. Basically the broad categories of FRM part 2. Means what are the different type of the risk do you have? Market risk. Market risk means the risk which is coming from the market, means from the change in the interest rates, from the change in the interest rate, from the change in the correlation between the assets. See, you are just understanding the terminologies, okay, but you are not going deep inside it, because it will be covered in deep in FRM part 2. Clear? Because of the change in the prices of the commodities, prices of commodities, because of the change in volatility, that is also a market risk. Because of the change in the prices of the equity, these all are market risk. Clear? These all are covered inside your market risk. Clear? Now second part is the credit risk. Your second part is credit risk. Credit means what? Means the loan which you have given. Suppose bank have given multiple loans, okay, they have given the loan education loan, they have given home loan, they have given car loan, and so on. Clear? Banks have given so many loans. There is a possibility that to whom I have given the loan, they might not refund. We call that as a credit risk. Credit risk. There is also another type of credit risk, that is a counterparty credit risk. Counterparty means what? A given the money to B. Clear? In this situation B will default, okay, in this situation B will default. I call this as a credit risk. Clear? But they entered into a swap. We will understand what is swap, but I am just giving an example where they both entered into a transaction where they will both exchange money with each other, where they both will exchange money with each other, just like the futures contract. Clear? Suppose he is on the buy side and he is on the sell side. If the price will go up, who can default? If the price will go up, Mr. B can default. And the vice versa, if the price will go down, Mr. A can default. We call this as a counterparty risk, where your counterparty can default, Clear? This is a credit risk. Clear? Then liquidity risk. During the COVID crisis, I don't know whether you have observed the market or not. People, those who want to sell the shares, they are unable to sell because everyone was in the line to sell. There is no one who is ready to buy, and when there is no one who is ready to buy, market will crash and you will not be able to sell your securities. Clear? When proper buying and selling is not taking place, when proper buying and selling is not taking place in the share market, we call that as a liquidity risk. You are unable to sell your shares in the market because no one is ready to buy. COVID crisis, market is crashing down. Who will take the risk to buy at that point of time? That's why market is crashing with 10%. I have seen the crash of approximately 30% or 25% in a single day because everyone was selling it, no one is buying it. So when you want to sell it, no one is ready to buy, or when you want to buy it, no one is ready to sell. We call this as liquidity risk, okay, which is coming from the market, There is one more type of liquidity risk, we call that as funding risk. Funding risk means you want money from the market, but no one is ready to give you the money in the market. You want money, but there is a scarcity of the money in the market, no one will give you. In 2007 and 8 financial crisis, what happened? Those who are in the sell side, they are in the profit, but those who are at the buy side, suppose they have bought the futures, market is going down, now they need to post the margin, they need to post the margins with the exchange, but they are unable to post the margin. Why? Because they are not able to borrow the money from the market to post it as a margin, and hence they have to square off their position at losses, and hence they defaulted. This we call as funding risk. Clear? I give you one more example of liquidity risk. You go to any bank, okay, any bank, you see there are many people who come to deposit the money, many people who will go to withdraw the money. Clear? In a very rare case, you will find out that bank is short of money, in a very rare cases. So they have designed their models in such a way to understand that how many deposits will come today and how many withdrawals will take place today. Clear? And accordingly they will maintain the reserves. Clear? Suppose they are estimating that today there is a deposit of $1,000 and there is a withdrawal of $1,500. In this situation they will keep the reserves of $500. Clear? So they are having these type of model where there is no liquidity crunch in the bank. Okay, people, when they will visit the doorsteps of the bank to withdraw the money, they can get the money. Clear? These all are covered under the liquidity risk. Then we have another branch of risk, that is operational risk. Means any type of frauds in the bank. Clear? Human frauds. Clear? Anyone stole the money, okay, or any type of error, that is also the part of operational risk. Means someone came to deposit the money, $1,000, but the employee of that bank by mistake have entered $10,000. Clear? So this is a loss to the bank. Now bank will find out where is the mistake and they will reverse the entry. But if suppose that person would have withdrawn that money, then it will become very difficult for the bank to recover this money. Are you understanding? So these all are important points. Even the cyber risk is the part of operational risk. Clear? And apart from that, there are some other types of small risk like regulatory risk, okay, which is coming from the regulators. Means for the bank, who is the regulator? RBI. Okay, RBI have introduced some new policies, okay, they have changed the procedure of doing something, or they have made some huge changes in the disclosure policies. So these all will impact the banks. Clear? Business and strategic risk, reputation risk, all these are the different types of risk. Clear? So you see, you don't have to over here keep focus that I want to understand the counterparty risk, credit risk, operational risk as a whole. No, just have a thorough understanding what they are. That's more than enough. Clear? Because once you'll complete the full syllabus of FRM part 1, you don't have to study this chapter 1 and 2 again, because each and every topic which have been discussed in this area have already been covered in a minute detail in the coming ahead topics. Clear? But in the beginning, if you'll do it, your mind map is clear that what FRM is all about. Might be you won't be able to understand each and every word in detail because I have explained each and every point in the coming topics in minute detail. Like if I'll give you an example over here, in the point of types of risk, in this point, measuring and managing risk, there is a quantification of the risk. Okay, quantification of the risk using quantitative techniques, and there is one technique known as VAR, that is value at risk. Now this topic discussed in detail in your book 4. Okay, there are dedicated 3 chapters which are there on the topic of war. So if I'll spend time over here so much on this, why not I'll spend the time over there? So you need to study strategically wherever points are coming, replicating. Okay, same point is over here, same point is over there, then let us understand where it has been explained in the better way. Clear? Similarly, if you'll see, there are points like hedging. Okay, because if you want to manage the risk, you need to do the hedging, but you will see in book 3, that is financial markets and product, described in a minute detail. Similarly, if you'll see the topics of derivatives, futures, bonds, all are discussed. Currency, commodities, all are discussed in detail in the coming topic. So just understand the theme of the topic, that over here author want you to understand the mind map. They don't want you to understand each and every point in detail, so that once you move ahead, your agenda was clear, that okay, what I am going to study, what is my roadmap, what is going to be the process, what are the things I am going to study. Now over here you got the idea that okay, war is something, okay, derivative is something, okay, bonds are something, okay, hedging is a process, is a way of manage the risk. So things are now clear, and once you will read hedging, your mind will recollect the thought that okay, hedging was to manage the risk. Now you are collecting the dots. So this is how you need to study. Don't take it as a burden of doing 60 or 65 topics. Take it as a process. Once you take it as a process, it's a single chapter that you have to manage the risk. In the management of the risk, there are 3 steps. Number 1 is the identification of the risk, number 2 is quantification of the risk, and number 3 is the management of the risk. These are the 3 things you have to cover up in FRM part 1 and part 2. Are you clear? Now you know that you have to do these 3. What are the topics coming under identification, what are the topics coming under quantification, what are the topics coming under management. So take it as a 3 topics. Okay, they are not 60 or 62, they are only 3 for you. Clear? Once you will study in this strategic way, things will become easier for you. Things will become much more intuitive, rather than you need to learn each and everything. So make yourself comfortable with the preparation. Clear? Now similarly, if you look at the topic 2, which is about the management, that how you will manage, because now you are suppose you are a financial risk manager of XYZ company. Now you need to manage the risk. Clear? So the first point discussed by the author is the corporate risk management. Corporate risk management, this is the first point which have been discussed by the author. Clear? Now when you are doing the risk management, I have given you the example that time that you have given the money to Mr. B. Clear? And you got to know that your there is a potential loss of $300. Whether you will be able to cope up with that risk or not. How you will get to know? You will get to know by identifying your risk appetite. Means how much risk you can afford. You say that, sir, I can manage the risk between $0 to $500. Anything between this range is affordable. I can manage it. That is my risk appetite. But beyond $500, I need to manage my risk. Clear? I need to take the hedging steps. I need to take the hedging strategies. Now when it comes to the corporate risk management, means I am talking about a bank like HDFC, SBI, or any mutual fund houses. Clear? So you have to take the steps to ensure that you will be able to manage the risk. Over here there is a role of the board of directors as well. Role of board of directors, they play a major role in helping the team to manage the risk. There is a risk mapping. Okay, you will study in minute detail in your FRM part 2. Okay, risk mapping, how you are going to manage the risk. Means suppose there is a mutual fund houses and there are 500 shares in their portfolio. 500 shares in their portfolio. Now if you keep on managing the risk of each and every stock, it will become very difficult. So what you will do, you map these stocks with the risk factor, with the risk factors. Clear? And then what you have to do, you have to manage this risk factor rather than managing these 500 stocks. Clear? Over here you will understand that what are the advantages and the disadvantages of hedging. Means if you are doing the hedging, then what are the possible advantages and what are the possible disadvantages. You will understand that what are the challenges that will come during the hedging. Clear? Then the next point introduced by the author is risk management methods and instruments. Means you are going to study each and every instrument in detail in the coming topics, that how you will manage your risk, what are the different methods and what are the different instruments. Means if suppose there is you have purchased the stock of oil, you have purchased the stock of oil, clear, and you want to sell the oil after 1 month. What you are afraid of? Sir, I am afraid that the prices of the oil will come down. This is the fear. Now what you will do in order to protect yourself, you will sell the futures, sell the futures of crude oil. Clear? If the prices of the crude oil, the market will go down, then this future will recover the money for you. This is an instrument. This future contract of the crude oil is an instrument for you. Clear? There is a possibility of the currency risk. You can manage that as well. There is a possibility of interest rate risk. You can also manage that. Clear? Are you understanding? Different types of risk are there. How you are going to manage these different types of risk? So we have these instruments to manage the risk. Clear? Sometimes a single instrument cannot manage your risk, so you have to create a box where you will take multiple instruments to hedge a single asset. Clear? We call this as, suppose you choose call option, you choose put options, and you take the help of the futures. Clear? We combine them together in such a way that these three will be able to hedge the risk of my asset at the lowest possible cost. Clear? We will study this in exotic options in your book 3, that is FMP. Clear? So my agenda with this session is totally clear, that study smartly, okay, study intuitively, don't study just to pass, okay, just filling up your pockets with the certificate will not help you. Always choose quality over quantity, always. Whenever it comes to studies, whenever it comes to friends, whenever it comes to books, whenever it comes to the games, or whenever it comes to the technology, take the quality rather than the quality. Clear? So over here I'm ending the session, and study strategically, follow the plans, follow the strategy, follow the procedure. You will see that your FRM will become very easy. Trust me, it's my personal experience with myself, with my all students till now, whomever I have taught. So if you'll follow that, you will be able to succeed. That's a guarantee. Okay, in this age I can give you the guarantee, and I mean it. Clear? Thank you.